welcome to the Monday Futures Market Outlook for May 17th, 2011. This is Patrick Serezna. For those of you that have not had the opportunity to try out eMoneySource.com's trading room, 5-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and we plot an 80-week moving average on there. It does a very good job to depict the bull and bear market cycles that we've gone through. We've, over the last 6 months, been looking for that rally to make it up towards this 1350, 1380 area on the upside, and subsequently some form of a corrective pattern to occur in the second quarter of the year. We're more than likely seeing that now well underway. And we certainly could see a solid 10 to 15, even 20% market correction in the market over this duration. In the end, we don't necessarily believe that that could be a beginning of a new bear market, but rather it may very well just emerge as being a corrective pattern that will represent a buying opportunity down the road. To just review the key intermarket observations, we still have an intermediate bullish bias on the markets, even though we're looking for a market correction and we're looking for the highs of the second quarter to come in somewhere along this 1350, 1380 area along the upside. We still do not have enough evidence to suggest that it's a beginning of a new bear market, so we remain intermediately bullish, but certainly having considerable short-term risk in being exposed to this market. We have seen a significant reversal in the US dollar, which is unwinding the commodity trade, and it's taking the wind out of the sails of the market overall. So long as US dollar strength is predominant anyway, it should continue to pressure all of the markets, particularly since the rallies in the market has really been in the resource and commodity-based style stocks. There is an increasing probability that we have seen a turning point in the intermarket asset class rotation, which you can clearly see by the rallying bonds, rallying US dollar, and subsequently weakening commodities, and now a weakening stock market. When we take a closer look at that S&P 500 on a daily chart, we can see that that blue zone was marked off where we're looking for the highs of the year to come in. There still is no real technical damage done to this market at this juncture with these reversals and breaks. There is room for the S&P 500 to work its way down towards 1290 and 1300, but there should be some important support lines that the S&P hits down over there. In the end, so long what we'll be looking for is after this wave of selling, if there is some sort of a reversal rally, we'll be looking to see whether that rally makes it all the way back to its previous highs, or whether it fails to make a higher high. As we have failed rallies after this sell-off, that would certainly continue to suggest that there could be further weakness going into the summer. When we take a closer look at that US dollar, which we've been discussing there, you can see how we were looking for that low to come in somewhere around that 72, 74 area, and we had a very robust squeeze higher, primarily driven by weakness in the euro. At this stage, it's quite possible that that was a very significant low, and while there at some juncture here we're probably going to have a US dollar that backfills towards 75 or even 74.50 on the downside. In the bigger picture, the US dollar should or could work its way up all the way back to 77 and even 79 on the upside. During that cycle of US dollar strength, it will make it very difficult for commodities to find a base. Next year, I want to take a look at copper and copper futures, and essentially we have now broken to lower lows after an extended topping formation that took a better part of 4 months to develop. At this stage, with us now having broken it, there's a very clear and distinct downtrend in copper, and at this stage we're looking for copper to continue to roll over and work its way down towards the 373.80 area on the downside. Any short-term rallies in copper, particularly so long as they're failing at the 410, 420 area and rolling over, will only represent better levels to short from. Next year, I want to take a look at gold futures, and gold completed a measured move higher up to our 1580 target on the upside, and now subsequently is going through a corrective pattern marked off with a blue line, the zones where roughly the lows came in on the last push just a few weeks ago. And really at this stage, if gold in any way breaks that level, we'll find ourselves relatively quickly in the 1420 to 1440 area on the downside. At some juncture, gold, silver, and will actually have a bounce higher, but more than likely, the highs of the second and third quarter are probably in on both commodities. When we take a look at silver futures, we didn't really put any focal points in there. We just simply wanted to comment on the degree of the bubble burst that has occurred up until now. At this stage, the continued deterioration of silver down toward the consolidations in December and January around the 27 to 31 area are all realistic downside targets. Anyone that is currently short silver or trying to participate on the downside, those are all levels where it would be very prudent to consider taking profits on short sells for what will eventually be a bounce in silver. Next here, I want to take a look at crude oil, and essentially crude oil had a significant reversal, obviously, the other week, and continues to deteriorate. So long as U.S. dollar strength is predominant, we could find ourselves down towards that $90 level on the downside where all those big consolidations occurred. And in bigger picture, if the selling does continue for deep into the summer, crude oil could be trading even as low as 80, 85. But that wouldn't call it a short-term target on the downside. That's probably something that would be more realistic over a 2 to 3 month time horizon. Finally, I want to take a look at that 30-year Treasury bond, and we were looking for bullishness in the Treasury bonds if there was going to be that intermarket asset class rotation. There continues to be bullish follow-through on the upside of these Treasury bonds up to our upside targets. Really, at this stage up here, we are looking for probably there to be some sort of overhead resistance somewhere in the next handle or two on the upside, but essentially even if there is some short-term profit taking in these Treasury bonds, this is probably now a new multi-month trend that could see even 130, 132 on the upside over a couple months. That was your Monday Futures Market Outlook. Thank you for joining me.